Hey, old dogs. I just want to take a moment to welcome a new sponsor to the show, Smart Move. Smart Move is the best way I know to protect yourself from evictions and bad tenants. Smart Move has a special offer just for Old Dog listeners. Just go to tenantscreening.com, enter code OLDDOG25 at checkout, and you'll get 25% off your next screening. That's tenantscreening.com, enter OLDDOG25, and get 25% off your next screening.
This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we've got a fun show for you today. We have a gentleman who has a very interesting background, and he has applied some of his technical skills to real estate investing. I am talking about Raj Tekchandani, founder and managing principal of Smart Capital. He's a seasoned technology entrepreneur and product marketer who is now a full-time real estate investor. Prior to starting Smart Capital, he spent over 3 decades with tech startups in the field of business intelligence and data analytics. He started investing in real estate in 2012 with the purchase of a single condo in Orlando, Florida. Then in 2018, after 5 years with a tech startup in the big data analytics field, he left his W-2 job to pursue his full-time interest in real estate. With his background in business tech and data analytics, he was able to leverage software tools to analyze and identify markets and deals in order to maximize returns while minimizing risks. In his pursuit of real estate investing, he stumbled upon the world of syndication and larger multifamily investing and started building the processes and systems of his company, Smart Capital. He remains passionate about the use of data and technology in real estate and also about educating others in passive investing. He is also an angel investor in early startup techs and advises on product development startups in real estate. Well, Raj, welcome to the Old Dogs REI Network.
Thank you, Bill. Great to be here.
Oh, man, it's great to have you here. What a background, from the tech world into real estate. I wish I could say it was the first I've heard of that, but it seems like engineers just gravitate to real estate investing. Now, what is it about that?
I think it's about, seeing that the real estate is, picking up on technology. And like a lot of other fields that already have, a lot of data analytics tools and companies doing data intelligence in their specific domains, real estate is just getting started up and there are companies coming out. That actually excites to a lot of us engineers who have that, computer kind of background. And obviously there is other benefits of real estate that we can go talk about. But yeah, that's the prime reason a lot of engineers get attracted to real estate, because it's a numbers game. It's becoming a technology game, and we love that.
Yeah, well, and it's a technology and numbers game that generates financial gain as well. So, I mean, when you can put all that together for a profitable business, that's pretty exciting.
Exactly.
Well, I read your background and that gave kind of an overview, but really, I'd like to kind of just hear, your story and how you, moved into this area and what was the attraction? How did you end up in real estate investing?
So a quick background, like you said, I undergrad in computer science from India. Wanted to build the next, big tech company. So I've always been passionate with startups. So, we had some good successful runs in some companies, not so successful in other companies. So that's the startup world we live in. But all alongside, I have been interested in real estate all along my life. My parents lived in a multi-family, sort of they owned back in India, and they were renting out 2 floors out of the 3, and now called as house hacking, a term that I learned later. Uh-huh. And that still remains source of their income through retirement. So always been fond of real estate, and coupled with the stock market debacle that happened a few years ago, I remained interested in real estate and invested gradually, slowly into one single family, a condo in Orlando, as you mentioned in the brief bio. And from there on, I've been interested in real estate and the passive income that comes from it. One condo turned into 9 condos in Orlando. Yeah. So, and it was slow and steady, the values that I saw going up. So there was some appreciation going on. And mind you, this was a time that was a good time to get in. This was the post 2008. Actually, I got a little late in the game, about 2012. And I saw the prices going up, the markets, looking favorable. But the passive income, without doing anything, I was getting a side check along from my W-2 income.
That's great. That's great. Now, with condos, it's a little bit trickier, isn't it? Do you also have HOA fees to deal with as well?
Exactly. So there's HOA fees, there is other recreation fees and all that stuff. So that eats up a lot into your profits. But like I said, that was, still, as long as it's cash flow positive and still making a couple of $100 a month, you don't mind that, because the rents are also going up in that area. And that's exactly the reason I started looking into multifamily and saying, okay, what if I owned all these and have one project, property manager? How will that look, without the HOAs and all those fees that we don't have to deal with?
And somehow you were sort of brought into the multifamily realm. How did that transpire?
So back in 2016, so I was looking at multifamily and reading about multifamily and the benefits of it. A property came on sale in a neighboring town, which is just 10 minutes drive or 15 minutes drive from my place. And it's in a bordering town, which is not as affluent as the town that we live in. But I knew of the demographics and the gentrification that's coming up in that town. And I said, why not? I mean, let's go take a look. I went down. It's on a main, road. That's a busy road. And I've traveled on that road, a few times. And I made the offer and got the deal done.
Wow. Is this also in the Florida area?
No, this is in Massachusetts.
So Massachusetts. Okay. Yeah, so you bought the condo in Florida, living in Massachusetts. Okay.
Exactly. Yeah. So
now, were you buying the other condos also in Florida?
Yeah, so all the 9 condos are in the same apartment sort of condo complex in Florida, managed by the same property manager who has been great for us. And thankfully, those condos have done well. But like I said, a lot of HOA fees and other stuff, made me look into multifamily.
Interesting. And so this was the first one near where you live, then, that our first property that you invested in the Massachusetts area. Oh, okay. Yeah. And tell us about that project. What how big was it? What kind of building? How old? That kind of thing.
So it's a 15 unit. They have 12 residential and 3 storage units. So, but like I said, some of them were low income housing, which I learned later about all these things. this was really an entry educational seminar for me getting into this because it was close to home and I could put the deal together. Also, all my money that was put into it.
Now, were you self-managing this when you started out?
No, I was not self-managing, and I was hoping that the property manager that was managing the property would continue to manage for me. It turns out that that property manager was actually the son of the owner.
Oh, gee.
As soon as the property was sold, his interest kind of dwindled down, and I was like left scrambling to find another property manager. So my model is not to self-manage. My model has always been that I can better use my time elsewhere and let somebody who is more proficient than me in managing properties do that.
Well, I imagine that. Well, it sounds like there's a lot of things that were going on there. I'm sure there was a lot of education that that came through owning that property.
Tons of education. The expense ratio was about 30-something%. That was pretty low. There was no, charges on the expenses that when I did the whole T12 analysis. A lot of things that I learned from that property, and as I learned more on the multifamily education and deal analysis, I'm not sure if I would have bought the property that I bought at that time now, because I know so much more, and it was just one of those things that was meant to be.
Oh, sure. How old was the building?
The building is early 1900.
Oh, wow.
Yeah, C-class. But now that we are owning it and I have a good property manager, we are slowly, remodeling it. The property is solid. The building is solid. Just the interiors have to be remodeled, and the rents in the neighborhood are pretty, aggressively going up. So that is one thing that has kept us going with the property.
Did you have any sort of deferred capital expenses associated with the older building like that?
Yeah, I mean, the roof was to be replaced, and we looked at that, and I sort of negotiated a little bit on that. But other than that, I mean, like I said, it was 100% occupied when we took over. They had 4 or 5 low-income housing, like the Section 8 tenants in there. It has turned around a little bit. I mean, it has turned around, like a lot of people have left. When we took over, everything was in disarray. People were not used to paying rents on time, and the property manager was collecting them at will, or, some people were paying months later than when they were supposed to. So all those had to be cleaned up, learning lessons all along the way, some evictions, visiting the courthouses, but it's getting stabilized.
That's great. Now, you started moving into larger units, obviously, and I was kind of curious, sort of where the tech and data analysis, analytics part of it came in. Did that happen right with this 50 unit, or was it later on?
No, it was all along, right? So I was working all during this phase. I was working with a big data analytics startup in the Boston area. And we were doing a lot of data analytics for, pharmaceutical and financial companies. But the underlying factor is still the same. If you have a lot of data, if you can harness the data, and if you can put some, intelligent algorithms on top, you can, come to a lot of good decisions based on that data. So we call it the data-driven decision making. And I was seeing, some signs of that in real estate, and I wanted to explore more. But in any ways, I mean, I spent 5 years in that startup, so I was fully vested in terms of stock options. I was like, I can go do another startup, or I can do this full time. Now that I have some source of passive income, and I said, if I go out and do another one of these, maybe 25, 50 units, I think a passive income would at least take care of the W-2 salary of a startup. You know how that is, right? I mean, the startup salaries are not that exciting. They entice you with the stock options.
Exactly.
So I said, okay, and fortunately I have a spouse who's very supportive and also, engaged in a full-time job. So there was some stability in terms of financial things there. And I took the plunge and set out to, buy another 25, 50 units in my neighborhood or Massachusetts area.
Now, were the numbers working for you? Now, in Massachusetts, like California, the cap rates I would think, be a little bit more compressed. Were you finding that at all?
So exactly for that reason, the business plan was very short-lived.
Okay.
And I started exploring out-of-state opportunities. And I had learned about the whole syndication thing through a friend of mine who was a sponsor in a deal, but that was 3 years ago to my starting this venture. And at that time, I did not invest in his deal in Georgia because the reason I didn't know enough, and I would not invest if I didn't know. But as I learned more about syndication, I read a lot of books, I attended a bunch of seminars, listened to a bunch of podcasts, and I approached that syndicator again. I said, now that I know more, what is going on? And they said how well those properties have been doing, that the ones that I didn't invest in. I said, great. But they had some other opportunities to take a look. So I did that and invested passively in Georgia with the same sponsor 3 years later. That was the beginning of my syndication journey.
Did you go in more as a passive investor, or were you a GP in that deal?
That was strictly an LP deal.
LP deal, okay.
But and just because I wanted to learn more and see what is involved and what do other LPs expect out of GPs. But very soon I realized that I wanted to do this more actively, and I said the next deal that comes along, I want to get more involved in due diligence, in analysis. Maybe come on as a key principal, and I would still be investing alongside in passively, but I want to play a more active role, and that's how I got into the GP side of syndication.
I see. Yes, as an LP in that first syndication, did you feel that you had enough access to information, to make that a more educational experience, or do you feel it was kind of restrictive a little bit?
No, I took it as a more educational experience. The investor reports, the investor dealings, and I was more involved than maybe other LPs are because of how eager and keen I was to look at the T12s and what exactly each line item meant. What is the cap rates? What are the assumptions on exit cap rates? The rent bumps and all that good stuff that we project over 5-10 years. What's behind that? And again, leveraging some of the technology tools, which I'll talk shortly, to do that.
Yeah, definitely kind of brings me to that place is that, okay, here you are, you're in Massachusetts, you're realizing you're not able to find the kinds of deals that make sense financially, I would assume, that you started to look into new markets. Now, were you starting to tap into some of your data, the sort of data mining or data, analytics to start to look at other markets and, see where the promising markets were for you?
Yes, exactly. So, I figured out what are the data sources out there that, so first you figure out what the criteria would be, right, to invest. And you go through that criteria and you then figure out what data sources are available. And then you sit down and compile those and, figure out some basic level of, analytics to see what can be done. And then also alongside, I started looking at, technology tools that may be already doing some of that, what I was trying to do. I was not going to build another software company or another, early startup just to do that. So I partnered with, a couple of companies. I found out about, companies doing that similar stuff and got started talking to them. And they had, products out there in the market, some I didn't like, some I liked, some I thought, could do much better, and stuck along with some of those technologies to use them and, basically do the analysis through these technology tools.
Did you tie into, there's so many different, as someone who, I am an out-of-state investor, I live in California, but I invest in other states. Mm-hmm. And there's just certain places that I go for data, I usually sometimes, we'll start, for example, with census.gov and, look at, where population growth is, where are people moving, where are, just a lot of demographic info. And then from there, I start getting into more specific things where I'm tapping into county data, where you're getting, the types of buildings and the owners of the buildings and that kind of data. So you're going from a lot of public information into now you're digging. You have to really dig to get into those other. Are you linked into a lot of different sources to put your data together?
Yeah, so that's a process. That's an ongoing process, but there's a lot of public data available. You can take census.gov. You mentioned there is Justice Map. There is Great Schools. If you're looking at schools, there's Wikipedia that has a lot of data on the MSAs, and the list goes on and on. And there is Rent Cafe. There is Bureau of Labor Statistics. There is hometownlocator.com, that has a lot of interesting data. So base point is there is a whole slew of data that's out there that is, and right now what I'm talking about is all free data. Then there is other data sources that you can tap into that are, maybe a little pricier, but I'm just talking about free data for now. So there's all these data sources that are available that you can look into, and you can somehow tie them into, okay, I want to look into, because I had a property in Massachusetts and I dealt with the tenants, which is not a very landlord-friendly state. So my thing was, okay, I'm going to look into the landlord-friendly states. So what are the landlord-friendly states? And there's data on that. So I'm going to look into, places that have less crime or better schools or a population. So all those things you can say, I look at MSAs that have populations of, greater than 200,000. Well, Wikipedia has some of that information. You could break down into, MSAs and tell you which MSAs have grown in population over the last few years, because that's also important. The problem that should have a, expanding population, not a stagnant population.
Yeah, that's huge. Just trying to look at that. But then you've also got the job data, right? So you're looking for places where there's lower unemployment, where, there seems to be a, growing or working population.
Yeah, lots of there is, how much is the owner, the price to own versus price to rent. So if you have, very high cost of ownership, then people will be renting more. But all that data is available. And like I said, there is crime data, there is median income data. You want to say, okay, I want to have a property that has, a certain median income level. You don't want to get, below $30,000 or, something like that. So you can put all those criteria into, your analysis and come out with the areas or MSAs or even submarkets identified, for out of state investing.
So you've got your market criteria, which it sounds like you have that pretty well defined, right? In terms of who are the people you're targeting, right? Mm-hmm. And then you've also got your property criteria, right? Are you also looking for a certain class of property, a certain type of property?
Exactly. So we look at mostly C plus B minus kind of properties, or C plus B minus, or B. Nothing very distressed as in D class, or nothing absolutely stabilized in A class newer properties. We don't do that. So somewhere in the middle.
Gotcha. Do you get specific in terms of, type of roof, type of, garden style?
We do all that pitched roof, garden style, there's a bunch of other things, we have. Then comes the whole financial analysis, which is we can talk about later. But yeah, property type, pitched roof, whatever is thing, and the location and the path of progress, what's around that place. Is it, what kind of anchors do they have? When I talk about anchors, which means is it a hospital, school, or, Air Force base, which sort of can have a negative connotation that you should have multiple of these. You cannot be relying on one source of economy for that area. So we look at the diversified economy as well.
And I imagine in that process too, there's also data that is not so much part of a database, but maybe it is. Maybe something I don't. But where you, for example, you may have an area where Nike is going to be building a new factory, or Amazon is coming in. This kind of data, I would think you'd have to dig more through business publications and things like that.
You can dig more, and those data kind of comes from paying some price, like CoStar or, Neighborhood Scout. They would give you some of those upcoming reports. You can always look into, some of the other industry reports that are out there. Brilliant guys like CBRE and Marcus Millichap. That's their job, to figure out, where the next boom is going to happen. So keep an eye on that, those kind of reports. They issue quarterly reports on multifamily for each of the, larger cities or towns. And so keep an eye on all those things to figure out and take that into your analysis as well.
Now, is that something you can access online, or do you generally just have to peruse those reports yourself?
Yeah, they are available online, but you have to create a login for certain places here, or, you can ask your broker to, if you're really zoned in on a certain MSA, like we did recently for Kansas City. And then you can talk to your broker about, those reports. They have access to all those reports, and they'll share it with you.
That's one thing. If there's a market that I've really zeroed in on, getting to know brokers in that area so that you can get on their offering memorandum list. I think that it's the sort of back end of those OMs that are so helpful in terms of market research. You look at stuff. Gee, I didn't even realize this was going on in this area. That they really do have some great great resources there.
Yeah. So, if you do what I talked about earlier on, if you set your criteria right and you stick by it and you run the data sources, and you have to also validate some of these data sources on your own. Some of the data could be outdated. So you want to make sure that you, sometimes you have to visit these places or have some boots on the ground to verify some of what's going on in what you read in those reports. But I think the reports, some of the data is pretty good. The census data is good. Some of the hometown locator data is good. Which is published, very often.
Now, your company, Smart Capital, so do you work with real estate investors specifically, those that are seeking out markets? How does that company, work, generally with the public or with the companies that acquire that kind of service?
Yeah, so I think Smart Capital is into, syndication business, right? So when I set out, I thought, okay, we'll find deals and then we'll property manage these. And so the goal was much larger. But then I figured out as we went along that, some of these things are best done in partnerships. So along the way, we found partners that, were very good at, let's say, construction management or asset management or, people who could do analysis just like we do. And people who have the networks of, retail investors that we can all collaborate and, raise the funds to close the deal.
So you're locating first, I would say, key markets, right, where there's potential. Mm-hmm. Do you try to get markets that are maybe sort of newer markets, emerging markets that most people don't know about, or does it lead to markets that where there's already a lot of activity?
No, I think it's leading us mostly to, some of the lesser known markets. There is obviously deals to be had in some of the known markets, but so, we did deals in Thomasville, Georgia, Dalton, Georgia, then we did a deal in Amarillo, Texas. And the last one was in Kansas City, Missouri. So obviously Kansas City is much more known name than some of the other names that we have done deals in.
So you're moving into those secondary, tertiary markets as well. Are you still maintaining the sort of the 200,000 plus populations, or are you?
At least in the MSA area is what we think about.
Okay.
So you can't find. So you have to have a neighboring town or neighboring neighborhoods. Basically, when I say MSA, and it's not. We don't want to go too low. But 200 is where we say if it's around 200, that's a great number to be in.
Right. So are you looking at maybe something within a certain distance from a major MSA? So, if you pick a, maybe a secondary, tertiary, would you want it to be within 40-minute drive time?
Yeah, 40 minutes is a good travel time, I think I would say, to, a major, MSA area. Like Thomasville is, close to, Tallahassee. Mm-hmm. Amarillo is close to, a bunch of Texas Tech and other universities. So that's a growing. Kansas City is, of course, it's a growing and happening city right now. So that's all. Yeah.
Gotcha. Yeah, and you mentioned something too that I thought was interesting, and that is regarding military bases, and that is that's one that can be it can be a great place to go, but of course if there's any potential, or possibility of that base closing down, it can devastate an area, as I've seen in different markets. So how do you usually approach the military bases?
So, I mean, if military base is one of the anchors, it's fine. Like I said, you have to have multiple anchors, right? Hospitals, educational institutions, bases like that. If there is multiple anchors, that's great. I mean, if there is only one anchor and that happens to be a military base or an Air Force base, then that is a very risky proposition for us.
Right, exactly. Just like any industry dependent. I remember that was the issue with Houston years ago when the oil business took a dive, and boom, it's had just a major falling out there in the local real estate market.
Mm-hmm.
One thing I'm really interested in too is so you started off with just a smaller number of units, 15 units, and you're growing now. You're buying 225 units in Amarillo, or you already own 225 units in Amarillo. Do you have like a goal in mind, or you're just looking at properties, ranging? Do you have a sort of a base number of units that you will look at, and a maximum number, or whereabouts are you in terms of the actual size of the properties?
I think right now there's no such base number, but I think I would say the Kansas City was 80 units and was fine because the numbers worked out well. We wouldn't do too small property just yet. Because it's just the way we are thinking. And there is no eagerness or desire of doing 500, 600 units if it doesn't work out. So our sweet spot is between 75 and maybe 300, I would say. It's a big range. But
yeah, big gap, yeah.
Yeah, but more like under $20 million for now on a purchase price. So that's where we look at.
Okay, so more of the actual price of the property.
Right.
Yeah. Okay.
Yeah. Because we want to know, what's the raise going to be, and if within our partners we can, commit to that raise.
So the process of your underwriting, is that also something that's tied in your technology, or are you doing that mainly from a manual standpoint?
No, that is the first thing that was the first thing that I thought should be automated, and thank God there were tools already out there. If not, I would have probably built one. Yeah.
Tell me about that. I'm interested. Yeah.
So, a company, there's a bunch of companies now, but the one that I am really liking out there is called Enodo, Enodo. These guys, brilliant guys out of MIT, Columbia, I think, engineers, they figured out the need, and they built out a, software to basically take in all the T12 data, the rent roll data, and any other data they can, get onto from external sources. So if you have PDF files of rent rolls and T12s, going out to multiple years, they have a system that'll, take that data and ingest is what we call it, ingest that data and come out with, spreadsheets that you would have come out, spending 5-10 hours doing it yourself.
Wow. Really? Mm-hmm. That's a great service. That's fantastic.
Yeah. And not only that, and they also know based on the neighborhoods or, what rent ratios are available. So or what class of property, if it's a C class property and your expense ratio turns out to be, 30%, they flag that out with a red flag saying, take a look at this is not what we have seen based on their machine learning and other data analytics. That should be the case. So there is something going on for you to be alerted.
Wow, that's great. That's great. What a great service. I'm definitely going to put a link in to that one too. That's great.
The founder, Mark, he and I talked initially a lot to figure out where their product map was going on. And I liked a lot of what they have been thinking in terms of, because everything is based on data, you put in the zip code for the property or even the property address. and it brings up all the neighborhood 1 mile, 3 mile, 5 mile radius properties that are similar to your properties. What are they being rented for? And so they'll give you the comps right away, so you don't have to.
Gosh, that's great. Man, oh, that's really, I mean, that's hard to get. That's information's difficult to get, definitely.
So yeah, they're tapping into the property management systems, and basically doing data analysis and all that. And they have, algorithms and machine learning programs that constantly learn from this data. So they're building on their artificial intelligence to improve their own systems to, better data analysis for the future.
So they're constantly refining and improving their system. Great.
Yep. So as more data becomes available, their systems get more smarter. That's the whole theory behind machine learning and AI.
And is it a free service? Is it a subscription service?
No, this is a subscription service, so it's not free.
Gotcha. Great stuff. Great.
And a lot of other companies are going to come out and, tacking along for different aspects of things. My focus has been purely multifamily residential, but I know there's tons of companies in the commercial space that are doing, space analysis, lease analysis, all that good stuff. But the one that I really like in the multifamily apartment space is this one. And they're doing other things that, in the future will be very good for our own analysis.
Right. One thing that's really interesting about your background and impressive too is the fact that you just kind of jumped in and you just started buying and learning as you go along, and refining and learning from the obviously the mistakes as well as the successes. And so I made me zero in on what would you say when your biggest mistakes was early on? That's something you've learned from that you've since have sort of readjusted and to make things better.
Well, I think I learned early on that due diligence is a key aspect, and it's never enough, right? If for the 15-unit property, if I had all the processes for due diligence that I know now, like I said, I might not have brought that property. But blessing in disguise, I did purchase it, learned along the way about due diligence, about all the ratios, about the markets. So I've learned along the way. So it's been. It wasn't a mistake, but something that I would have done differently if I had done it now.
Tapping into more data in your due diligence evaluations.
Yes.
Right. What about on the success side? What have you done that's really made a difference in terms of the success of the projects you're doing today?
So one thing, interestingly, is along the way, not too long ago, I started a meetup. And I consider that a success because I think I had reached a certain point that I knew enough about technology and the data and syndication that I said, okay, you know what, I'm going to share this with other people and learn from other people. And I started going to meetups and networking events, and I didn't find anything that was very interesting to me in terms of the focus they had. People were talking flipping and wholesaling and all this other stuff in the same meetup. So I started a meetup, I call it the AIMS, AIMS, for apartment investing and multifamily syndication, just to focus on technologies and the processes, analysis, data analysis for this kind of investing. And I think that was a success point for me because I had reached to that point to initiate a meetup. And the meetup has been very popular in the Boston area. In fact, just today we have a large meetup, a large gathering coming out to hear about market analysis using data.
Yeah, I would imagine you'd attract people from all over the place that would want to do that. Are you forming sort of little groups in other areas, or maybe you're thinking of going online?
I was thinking of going online for sure because as I posted this meetup, I got comments from on Facebook saying, "Hey Raj, very interesting meetup, but we are in California, no way for us to come to Boston. Can you record it or can you telecast it?" And then I've been thinking about that for a while, but I haven't got the bandwidth or time to just put things in place. But I think that's coming soon.
Yeah, we definitely want to get a link to that. If you do that, that'd be something that I think a lot of our listeners would be interested in.
Sure.
Well, speaking of our listeners, a lot of them, as you know, are 50 plus in age. They're either approaching retirement or already in retirement, and they're looking at real estate investing as a means to either supplement or sustain their retirement. And they're looking at it at many different levels. Some want to be very passive. Some actually want to go in and acquire their own properties and so forth. What kind of advice would you have for those folks, starting a little bit later in life here, that would, that you think would be wise, sage advice here for them as they are considering, real estate investing for their retirement?
I mean, I'll give the same advice that I'll give to an 18-year-old or 55 or whatever the age is. It's education. I mean, there is no substitute to it. When you're younger, you don't have, that much of a risk. But when you get older, there is a lot of risk because you saved this hard-earned money and you want to make sure that you're investing it carefully. And there's a lot of ways to invest it, but I would still advise on getting education on it. And it's not hard with the advent of, YouTubes and podcasts, and you don't have to go to school or anything. You just have to be interested and listen. And that's how I learned it in the last few years. And I see no reason why anybody else cannot do that. So my advice would be the same. Figure out, what education or what investment options are out there. Figure out what sits in well with your profile. If it's, commercial, if it's multifamily, or is it single family. But once you figure that out, or if it's maybe a blend, learn as much as you can on that topic. I mean, there are meetups that, are out there. There is chapters of, people that will meet online out there. So there are resources available. There's a lot of free resources to learn. There is, books on syndication that are available now, or websites are available. Tons of material out there. Just get educated.
Great. What about mentoring or coaching? What's your feeling on that?
I love mentoring and coaching. Unfortunately, there's too many coaches and mentors out there charging too much money, which I do not really, fundamentally doesn't sit well with me. But I have seen some newer coaches or mentors that are willing to do it for either free or, very minimal charge. They just want to give back because that's how it is. I mean, my meetup is sort of an educational meetup. I don't charge anything for it. Anybody is welcome to attend it as long as you stay interested in the topic. I have, an open door, phone call. You can just call me anytime. I'll talk to you regardless of, what your interest level is, whether you're looking for passive investments or active investment or syndication or multifamily. I'm open to do that. So, yeah, I mean, definitely mentorship is great, but, find the right mentors.
Yeah, great advice. I feel the same way you do. One thing that I'm curious about too is you've off to a great start here in a relatively short period of time. And so, do you have sort of an end game or at least a goal that where you want to get with your company? Where do you want to see it go?
I want to, obviously it's a real estate investment company. Maybe after I get very comfortable and have few success stories. When I say success stories, which means return of capital and making my investors a good sum of money over the years, maybe expand into different asset classes. But one thing that is consistent is I always want to have an educational aspect for this company alongside. That any investor that wants to invest with us is able to educate themselves or himself herself to know what they're investing in. So that'll always be the case. So I want to build better, systems or tools out there to share that knowledge and even make it easier for, syndicators to interact with passive investors in sometimes some kind of, user experience. So I want to build better user experience for investors, better education for investors. I don't have any goals of, X number of units by this time. That's not my goal. One investor at a time, make them happy. That's my thing to do.
I like that. Great stuff. Evicting a tenant can be painful and cost as much as $10,000 in court and legal fees. The best way to protect yourself from evictions and bad tenants is to screen your tenants. And the best way that I know to screen your tenants is Smart Move. SmartMove is part of TransUnion, a trusted consumer reporting agency with more than 4 decades of experience. They built an online screening service for independent landlords that delivers critical credit and background reports to you in minutes. It is a valuable tool to help you when you are trying to decide who to put into your rental property, and they can help you find your next great tenant. Only SmartMove has a credit score built specifically for rental screening called Resident Score, which can identify eviction risk 15% better than a traditional score. With the SmartMove report, you'll also get a criminal background check, eviction history report, as well as a full credit report. And only SmartMove has Income Insights, a report enabling you to analyze renter income to determine if further verification is needed. See why 9 out of 10 users recommend SmartMove, and more than 4 million landlords have used SmartMove to make better leasing decisions. SmartMove has a special offer just for Old Dog listeners. Go to tenantscreening.com, enter code OLDDOG25, and you'll get 25% off your next screening. That's tenantscreening.com. Use code OLDDOG25 at checkout for 25% off your next screening. SmartMove. Reduce your risk of non-payment and evictions. Man, I could talk to you for a long time here. Definitely, you've got a lot of information and knowledge that I think is of value to the folks listening and myself personally too. I think this is great stuff. And but I've got to respect your time and the time of our listeners here. And so we're moving into what we call our wrap it up session, sort of a lightning round. Where I ask you a series of quick questions about resources that you use so that you can kind of share that with our listeners and they can learn about new things and new resources. So if you are ready, we can go ahead and wrap it up.
Fire it off.
Okay. Favorite real estate book?
Other than the one that I'm writing right now, which will...
I didn't know you were writing one.
It's still early stages. I mean, it'll definitely come out in form of an ebook. It's basically talking about how to leverage data for passive investments.
I love it.
But other than that, I've read Rich Dad series. That's impressive for the real estate. And, some of the new books on syndication, if you are into that. But Rich Dad is a good start. And that's about it.
Okay, great. How about favorite just general business book?
I like The One Thing by Gary Keller. That's the one I read, and that's how it helped me focus on, doing a lot of different things to just focusing on one thing, which is now apartment investment for me.
Great book, yes. How about most valuable website for success, of course, other than your own?
The caveat. I like Bigger Pockets. I mean, Bigger Pockets is a good web place to be if you're just getting started, or even if because it's segregated in forums, whichever your interest is. So that's a good place to start.
That's great. How about a favorite app, being a tech guy here?
So you'll be surprised. The favorite app for the tech guy is very non-technical. I like an app called Insight Timer.
Never heard of that.
It's an interesting app. It's you'll see what it is. It's about taking time off from everything else that you do. So it's sort of meditation and calming down yourself app, which is free, and you can just take 10 minutes or 15 minutes. You can program what you want to do. 5 minutes, you got 10 minutes, you got 20 minutes, or you got half hour, and they'll bring out some kind of meditations or just some kind of relaxing tones for you. And the other one that is called Wunderlist, which is WUNDER list, which is for just daily organization of your activities. Those are the two favorite apps that I have.
Oh, cool. I hadn't heard of either. Wunderlist, is it sort of like a to-do list?
Yeah, it's a to-do list, and you can organize it very well. It's one that came out early on, so I got latched onto it. I'm sure there is newer and better ones, but...
That's good. Yeah, I'm always looking for that. I'm still the old school, type up my task list for the day.
I used to type it up, but now I just type it on my Wunderlist.
That's great. Okay, how about your favorite quote?
So many of them, but this one stands by me every time I read it or I look at it. It says, "If you want to achieve your goals, help others achieve theirs," by Zig Ziglar.
That's a great quote. I love that. I think that's an important part of what we do. If if we're not giving back, I think we're people are missing out if you're not. I mean,
yeah, and you get so much in return. Don't even know when you don't expect it.
No, it's true.
Just do it for others. Yeah.
And then sort of our wrap-up question here: if something happened and you lost everything that you have, okay, and you are just down to $1,000 in cash, what would you do with that $1,000 to relaunch your real estate investing business?
Oh, wow. Yeah, so I think if I had the knowledge, and if maybe times change, that if I needed to learn more, my first part of that 1,000 will definitely go into educating myself to figure out what I can add value to others. If I can do that, I will, and the remaining part of the $1,000 I'll spend to maybe invest in finding those people that I can partner with. So I'll take those $1,000, split it into two parts. One is education, and the other would be finding, people that I can add value to.
Got it. I like that. That's great. Wow. Well, there's a lot of folks listening to this that I'm sure are going, this is a guy I need to find out more about. Need to get a hold of him. So what is the best way for folks to reach you and to find out about what you do?
I'm, on all social channels, Facebook, LinkedIn. My email is easy, raj@smartcapitalmgmt.com. So that's Smart Capital Management for short. So smartcapitalmgmt.com. Great.
Well, we have a tradition here, as you know about if you saw the email we sent to you, that all of our guests get to close us out with their best old hound dog howl.
Right.
Okay. So
I knew I'll stumble upon one of your questions of all the list that you send me. I hope this is not the one.
That's the one. Yeah, most people are practice all week long here, so so you can just give it your best. Whatever you got. Let's see if you can close us out with a hound dog howl here. Wow, that was a good one. I've never heard one like that before. That actually may be entered into our Golden Howl Awards. We have our annual Golden Howl Awards, and so that could be a candidate. That is very resonant. It kind of had kind of an Indian thing to it. It was really good.
Indian hound kind of.
Yes, I liked it. That was great. Well, Raj, it has been great having you on here. I already realized about 15 minutes into this interview, I'm going to have you back because there's a lot of areas that you could zero in on, and I know in our short time period we really don't have a lot of time to address all these various areas. But love to have you back already. I know that.
Love to be back. Yeah.
That'd be awesome. And just want to thank you for coming on, taking the time to join us.
Thank you for the opportunity, Bill, and have a great day.
I appreciate it. I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note, listeners, everything presented here today and everything that Raj talked about can be accessed in our detailed show notes. And we'll try to get links to a lot of the resources that he mentioned, and we'll try to outline as much of this conversation as we can. We usually spend a lot of time on our show notes because we know that that's sort of the follow-up, so you don't have to, while you're driving in your car listening to this podcast, you don't have to try to take copious notes. You can just go to the show notes and everything should be there that you're looking for. So just look for the show with my dear friend Raj Tekchandani. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.